Welcome back, investors. Welcome to a new Vinley Radar video. This time we will be speaking about Netflix, who just published a couple of days ago their latest earnings for the second quarter of 2026. And so what's going to be part of the conversation is something that really stresses currently the market and shareholders, which is the amount of content hours viewed by Netflix users. So what is interesting, first of all, when you look at the share price, and here I'm taking a screenshot from Vinley, you see that the share price has lost rough cut 50% from July last year to July this year. So the stock has been beaten down, in fact, by shareholders and by the market. But let's look into the numbers. Instead of just trying to be emotional here, let's look at the facts. So first of all, when you look at the second quarter 2026 figures, you see that revenue has been up 13% year over year. Of course, if we leave foreign exchange, if we bring in foreign exchange, it's just plus 12%, but okay. It's rough cut more than 10% growth, which is still very good. And you can see on the table here that is extracted from the latest quarterly statements that growth is slowing down, let's be very honest, and they're already forecasting that the growth in the third quarter will go down to 11%, so less high growth versus the previous quarters. Operating margin is pretty decent at 33.4%, a little bit down from compared to a year ago, the second quarter of 2025. The earnings per share at 0.18, so that's that's good actually if you compare it to the second quarter last year. And the free cash flow, they generated less cash, but they generated nonetheless $1.53 billion of free cash flow, which is always a good signal because it can in fact support the company and specifically their financials. The headline numbers, of course we rely on what has been disclosed by the management of Netflix. So, the amount of viewers in the first half of 2026 has been, in terms of count of hours, 97 billion of hours, which represents rough cut 2% more year over year compared to the 1.5% in 2025. And so more than a third, in fact, is coming from non-English countries, in fact. So they are growing, of course, outside of the US. And you see here, without going to the details, if it is movies or shows, what are the ones that are driving most of the hours watched on Netflix? The main question, and I mentioned this also a couple of weeks ago in one of our webinars, that management from Netflix in fact gets, and I heard rumors that Netflix management is definitely looking into this, is engagement. And during the analyst call when they published the second quarter 2026 figures, one person, Rob Sanderson from Loop Capital Markets, of course had to address this point. So mentioning that the engagement quality is improving, but the per member viewing hours have softened, and why management remains confident about the quality and the growth of the earnings of Netflix. And of course, we are running Vinley ourselves, and of course, it's not all about just the amount of hours that users spend on the platform. And I always take, when I even speak to our team, I always take the example of Booking. I'm very convinced. So Booking.com has become a habit for me, but it's not for that reason that I'm going to be spending hours and hours on Booking. I just know that when I have to book an hotel, I'm going to go on Booking and very quickly do what I have to do and go away from it. And this is basically also a little bit into that direction that Netflix is now explaining, and I'm going to give you just the highlights. So first of all, when they speak about content spend, that is really every dollar they spend on producing, licensing, and even acquiring content. Because, of course, they also buy content from other, let's say, studios, and if it is movie makers or series makers. And what is interesting, what they are sharing is that, and I could observe it myself, for example, a couple of months ago, they streamed NFL games live on Netflix. I think there were 2 games that they streamed live, which was great, because this is actually disrupting all those sports channels which have very premium subscriptions. And what at least the Netflix management says is that those live events, even though they had to spend a decent amount of money, so 5% on it, it only generated 1% of the quantity of hours viewed, but they were able to capture signups because of these live events. So 6 of the last 10 top signups are actually coming because they are streaming now live events. So that's something that I do understand. And also so Gregory Peters, the co-CEO, president, and director of Netflix, was actually sharing that, well, first of all, when they look at engagement, and of course they will not disclose the details, right? But when they look at engagement, they will not just look at quantity of hours viewed, but also the quality and the variety of the hours, or let's say the content that is being consumed by the users of Netflix. And I fully get the point. And what he was saying, and this is normal in a company like Netflix, is that when he joined Netflix 20 years ago, that since then there have been 12 major iterations on how, in fact, engagement is defined at Netflix. And of course, in the beginning, and that's always the same for companies that follow Metcalfe's law, so the winner takes all. So they need to grow market share. So it's about quantity of users. First of all, they don't care about the quality of the viewing. Then at a certain point in time, it's going to be how do those users actually consume the content. And then at a certain point in time, obviously, it's going to be about monetization of those users and which ways and strategies of monetization you're going to have for those users. But I believe that I feel a little bit less stressed than a lot of shareholders by Netflix. I'm not a Netflix shareholder for the time being, but at least what they are providing as answers to the narrative, I fully get the point. I think at a certain moment in time, what also investors and Wall Street has to understand that those companies, and you see this in the projections, if I go back actually to the growth ratios here, when you look at the year-over-year growth, you definitely see that the growth is declining, and this is always the case. So we are seeing that Netflix is becoming a more mature company, and the question is, when they will be mature, can they still diversify? Can they still maintain their market share with new stuff? And specifically what will be important is the operating margin. So this point, even if there would be no growth, and growth alone is not a good measure of company performance, but they could be even stagnating, but as long as they are super profitable, that's totally fine. So again, this is a little bit my perspective on what shareholders and analysts are worried about the engagement. I'm not saying that it's something that has to be pushed aside, but it's something that has to be, of course, monitored, has to be acted upon. But as long as profitability is good, we will see Netflix, in fact, at a certain moment in time, I would say stagnating, or at least growing less fast as they were having a couple of years ago, right? And this is what actually is making markets nervous, because probably they have factored in their valuation that Netflix would continue to grow at 15% for the next 20 years. That will not happen, let's be very honest about this. This has happened to any company, if it is Amazon, and if it is Spotify, if it is Netflix. All companies at a certain time will reach a plateau. So they will have to think about better quality of revenues while growth will be declining a little bit, and or diversifying, so expanding the portfolio of products and services. And I will speak about this in a couple of minutes actually. So where the growth is coming, of course, I mean, they will continue producing content that people love. They mentioned this like series like I Will Find You, Swapped, and K-pop Demon Hunters. For example, my daughter, I remember that she mentioned to me the K-pop Demon Hunters. TF1 partnership in France, so there as well we see that, of course, more and more platforms, or let's say live TV, they're going to leverage actually the distribution channel of Netflix. That's definitely a mode that Netflix has. And then, of course, they are looking into podcasts and games. So podcasts, of course, this is actually eating, or let's say conflicting with Spotify, obviously. And then games, that's something that, in my opinion, when you look at a platform like Steam, for example, on PCs, there is definitely something to be done there. And what you see in the narrative, that the cloud game players has been up 11 times since October. So maybe part of the growth will come from games, for example, as well. What is interesting as well, even though I mentioned I'm not currently a shareholder of Netflix, they are spending a lot of money on share buybacks. So that's actually to, let's say, sustain the share price, even though the share price you have seen came down from $135 to rough cut $67 per share. So that's a rough cut minus 50%. You see, in fact, that the company is spending big amounts of cash in buying back shares from the market. So they're actually not diluting equity, but the other way around, they're concentrating equity, which is a good measure for existing shareholders. And what is interesting, they have received the authorization from the shareholders to still spend $27.1 billion of cash on share buybacks. I'll speak about debt versus cash and cash equivalent. So here it is gross debt, but even if you look at the financial debt, the company is from a solvency and financial strength perspective is pretty strong. And this is basically what I'm showing you here. I just took 2 screenshots from Vinley on the left-hand side. So first of all, I of course always look at reliability. It does look like as the financials are reliable. And from a solvency and financial strength perspective, so the Altman Z-score on bankruptcy is green, the debt to equity, that is also green, and then the interest coverage ratio. So they have debt, but they can pay out the interest expense to service the cost of the debt. They have 17 times the coverage on the current income. So that's definitely, I would say, for the time being at least, they have sound and strong financials. That's what the balance sheet on the right-hand side actually shows as well. What is interesting, and I was surprised when running in Vinley the absolute valuation. So that's the graph at the bottom left here. So you see that the latest share price was yesterday at Wall Street closing $67.60 per share. And according to the sensitivity analysis of Vinley, in fact, Vinley considers that the share price, the real value of Netflix, with 10% growth, I'm just going to explain the growth assumptions of 10% growth for the next 30 years, that actually the share price is between 81 and 100. So let's say rough cut 90. So it looks like Netflix is a little bit undervalued depending on the assumptions. Of course, if you factor in 5% growth instead of 10%, or you decrease the cost of capital, of course, intrinsic valuation, the absolute valuation will change. But at least it looks like the company is currently, people feel depressed about Netflix, and it could be an opportunity to really assess if it is, if the company, a great company with a very strong brand, if it is something that is worth potentially investing into or not. Again, as always, I'm not giving you financial advice here. I'm just really trying to be very transparent how I am thinking about these type of companies. So I hope that you like, again, this video of the Vinley Radar about Netflix this time. And as always, feel free to comment. And if you want to know more about it, feel free to, as said, to comment, to send us an email, and happy to respond to that. Thank you very much, and talk to you very soon.